Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for November 30th, 2020. Please see our disclaimer for important information. Well, as we begin our discussion this week, first of all, I hope everyone had a safe and happy Thanksgiving. I know this is an unusual time, and many of us couldn't be with loved ones that we would otherwise spend that time with, but nevertheless, hopefully you had a wonderful time, and we can all look forward to a better environment down the road. Now, having said that, here's the latest data from the COVID tracking project. The usual consolidated view that we have that shows both daily cases and daily deaths on that 7-day moving average wasn't available this week, so I went straight to the COVID tracking project to give you essentially the same data but in two charts. But here's a daily case 7-day moving average line. As you can see here in that last week, we had a noticeable drop after many weeks of acceleration in cases. So that's a very positive development. Obviously, we're going to be watching how the post Thanksgiving Day holiday weekend transpires, and with up to a 14-day incubation period, you know, the proof will be in the pudding here as we get into early December and especially into the second week of December data to see if this number spikes a bit more. But here is that 7-day moving average. Obviously, last week we did have a fairly strong spike, but we had a gap in the 2 weeks. You know, you can see that on the single individual week basis, you could see that really strong dip week before last, and that's kind of caused that little blip in that moving average data. But we're still very optimistic that this will crest at some point and, you know, continue to drop hopefully over the coming weeks. Here's the weekly daily death 7-day moving average. As you can see, that number has also dropped. Very positive development. We tend to see the daily deaths on an individual week basis kind of cluster around certain particular weeks, but the 7-day moving average line is clearly moving in the right direction. We'd like to see that. This is a number that we're paying a lot of attention to right now, and it's the hospitalization rate. Now, this is the aggregate number of those that are hospitalized across the country. I didn't include in this week's pack a kind of a hospitalization bed utilization rate, an ICU bed utilization rate, which I've done in the past, and we know that it's picking up in certain areas. But, you know, as I talk to individuals out there in the healthcare space, you know, the one thing that's clear to me is it's not necessarily an issue of bed space availability. It's an issue of staff availability. Now, you know, when we've had the prior outbreaks, and if you look at, you know, obviously the April and then particularly in the middle of the summer, that outbreak in the summer where you see that number of hospitalized rise, I mean, those were outbreaks in certain areas of the country, and we could mobilize resources in areas that didn't have outbreaks into those areas that did. Well, now what we're seeing, this hospitalization rate and the case rate is nationwide. It's almost kind of this general spread of the virus as people are getting tired. They're getting kind of, you know, COVID fatigue, if you will. And so, you know, you can't really shuffle resources around like we did in the summer. And so the real issue is having staff resource availability to treat those people that are presenting with symptoms. Here's our short-term or high-frequency indicators, and this is from last week, and will be really interesting to see what that data shows when we get through in the beginning of this coming week here, and we'll see all the Thanksgiving Day weekend data. But obviously, we know that restaurants activity is down. We know that hospitality activity is down. We know, at least in that week leading up to Thanksgiving, that motor vehicle traffic was down, and so that results in lower gasoline sales, box office receipts. You know, we've talked about this quite a bit, but you know, the manufacturing data, we'll see some of this in a minute. and the industrial data actually still pretty good, for the most part, both on a weekly basis and over the last month. And staffing seems to be, labor markets overall seem to be kind of leveling out. We don't have any labor charts per se this week, but we'll have a really good read on the first November unemployment rate and unemployment data here at the end of this coming week. So in the next chart pack, you'll see something related to the November employment data. Really, the only other takeaway here is that continuing claims are trending down. We've had charts on that in the past. That's a very positive thing. We know that some of that is in that emergency pandemic assistance category, and we know that some of those benefits are going to terminate at the end of next month. So obviously, we're very concerned with that. But overall, we like to see that downward trend in the aggregate data. This is something I thought was interesting from Arbor Research, and it's just basically a rolling 30-day sentiment of Twitter activity by, people that are kind of in the know, that are, spending a lot of time with the virus, so on and so forth. This is kind of a sentiment indicator, if you will, by all of these talking heads, as I'll call them. And you can see that the positive sentiment is really being reinforced. Now, again, a lot of this has to do with developments on the vaccine front, or at least some visibility towards, the end of this pandemic at some point. But I thought this was really interesting sentiment indicator for those in the know, and it's improving. So that's a good thing. This is something as we've been watching for, the developments on the vaccine front. We know that these three companies, Moderna, Pfizer with BioNTech, and AstraZeneca, have emergency use authorization for viruses. They've accelerated their development timelines. This, I've wondered this because it will speak to the speed at which the general population can get inoculated next year. And a lot of speculation on when that's going to happen. Obviously, first responders and frontline healthcare workers are going to be inoculated first. But you can see here that we're AstraZeneca. We've got a fairly strong production capability in 2021, over 3 billion doses. Pfizer and BioNTech, we're looking at least 1.25 billion doses, and then Moderna probably a little less so, but that's a smaller company with less production capability. But if you add all of those together, you can cover a lot of ground this year, and then that's not really including some of these other therapies. And we've seen in chart packs previously, there are a lot of drugs that are in this, kind of phase 1, phase 2 process. These three just happen to be the flag bearers for those who have already, applied for and in some cases received the emergency use authorizations. But a positive development here nonetheless. Obviously, a lot of doses are going to be available next year, but the real challenge is going to be the logistics in getting this out. The logistics in storage, and as well as the logistics in determining and verifying who gets the vaccines. So I'm going to focus a couple of charts here on really what's positive in this environment. The housing market is just going through the roof. This is new single-family houses sold. Now, September was at the highest pace since 2006. Sales in September, which is the last month of data that we have available, were up 29% versus January. Affordability is high. Inventory is low, which means prices are being supported. We're seeing a little bit of a subtle shift in people moving away from the urban core and moving to the suburbs, which is kind of interesting. Another thing which is going to keep the housing market strong and keep prices high is the month's supply has gone nationwide from April to September from 6.8 months to 3.3 months. And 3.3 months represents the lowest level since 1963. Very, very profound. And we know even from the Case-Shiller data, the 20-city index, that prices just in September alone were up 1.4%, and they're up 70% year over year, and which is astounding considering that we thought prices were up very strongly. The year ended September 2019, they were up 3.2%, which is considered in any year a strong year, but to have it be up twice that in 1 year during a pandemic is actually fairly profound. Manufacturer new orders and durable goods orders. This is a pretty strong number, and it beat expectations in the latest reading. It's only 2.2% below in aggregate below the pre-COVID high. We've seen a 44% rise from the bottom. In the latest reading for durable goods orders, ex-transportation, they were up 1.3% and up 3.6% versus the beginning of the year. And if you look at core non-defense and non-aircraft orders, they were up 2.3% during that same time frame. Really, really strong numbers from manufacturing, which is good. Here's our Purchasing Managers Index, PMI. Anything over 50 indicates expansion, so we're still expanding. That number has gone up from the rebound. That's another good sign. New vehicle sales. Now this is interesting. So inventory was down. We know we had curb production, but sales are trending above where they were a year ago. And so we know the automotive market's strong. Production is slowly catching up, which is a good thing. But you can see here certainly some health in the automotive market. Overall financial conditions, as referenced by this kind of glom chart of Chicago Board of Exchange, Federal Reserve Bank, Macrobond, and ANZ Research, just kind of shows you this composite view that that overall financial conditions are highly stimulative. Low rates. There's a financial stress index, which is low. Volatility, which is ironically very low, despite the fact that we've been dealing with a pandemic. But overall, I think this sets the table for a healthy, slow recovery in 2021 after we get through a little bit of noise here at the end of this year with data. I'll spend a couple of minutes on what I usually do in the chart pack, is just kind of highlight the issues with small business. Now this represents a difference between large and small caps, but it's debt to EBITDA. So, one thing that we're going to have to pay attention to on small caps. Now we know that the small cap divergence in terms of price response relative to large caps has been profound, but just the small cap sector, and like when I talk about that, I mean like the Russell 2000 index. Debt levels are higher than large caps, and there's just in general more financial stress at that small cap level. Small business employment. This is from Pantheon Macro, and it shows a trend. We've shown this chart before through posted on Daily Shot, but it continues to trend down. So this is stress in the labor market at the same time that we know that small companies that have access to debt have certainly increased their debt load, which was evidence in that last chart. But this is something that we're just going to keep our finger on the pulse of, given the influence of small businesses on the total economy. Now, I've been paying some attention to, and we don't do a lot of work in Bitcoin, but obviously the price of Bitcoin has gone through the roof, notwithstanding the fact that Bitcoin prices overall are highly volatile. But what's interesting is this. I put this chart in here mostly for the price impact, but ironically, it's done this at a time where so-called Bitcoin search terms in Google Analytics and things like that haven't really spiked. But the price in Bitcoin has really gone through the roof. Here's a quick snapshot of gold. Gold, punched over 2000, seemed to have some holding or staying power at the 1900 level, and it's kind of consolidated here. Now, we saw a big rise during the height of the pandemic, and especially into that first wave. And we've seen since then gold kind of taking a bit of a pause, but as I think you'll see, with negative real rates in this next chart, that I think gold has a lot of staying power here. Now it's probably going to jockey around this area that's kind of holding in right now, but I don't see gold peeling off in a very material way given those low real rates. So this is what I'm talking about. So on the left-hand side of the scale, you can see and this is inverted too, so you can see the real rate, the real 10-year Treasury rate. And you see right now, it's just about -1%. And you can see the correlation here between real rates and gold prices. And right now we're seeing a really strong relationship between the two. So as long as real rates stay certainly negative, but even negative to the tune of 0.5% or even 0.75%, you're going to see gold kind of hold in there pretty well. So here's a quick snapshot on oil supply and demand. We've monitored oil prices, which have kind of picked up a little bit. We've had a little bit of a tailwind in oil and energy overall in the last month. And so I thought it was kind of healthy to take a look and find a chart that kind of speaks to, what the supply demand imbalance is right now. And right now, you can see in this chart, basically from long view eco, that, we've had a fairly strong, I guess, demand contraction due to the coronavirus. People aren't driving. You just don't need oil. You don't need distillates, which means you're not, you're shutting down rigs. And obviously there's a production cost and unit economic issue on the part of producers, and that's why you've seen this massive supply reset, if you will. So a lot of rigs are being shut down. So you're not getting a lot of supply, even though we think rig counts have kind of bottomed here. But what this shows you in that spike there in the second quarter is that we had a lot of supply surplus just because demand had dropped off. And then you had a supply response, which is a lot of producers, especially the marginal cost producers, that it just wasn't economic for them to pump gas when prices were well below $40 a barrel. And so now we've seen that pendulum swing to the other side, where we're going to have supply deficits that are probably going to persist into next year, which I think in a strange twist of fate, because you've got that, I think that's going to help support energy prices heading into next year. This is a chart of gasoline prices. And again, this is nationwide. It's produced by gasbuddy.com. You can look this up on the internet. And what it shows you here in 2020, obviously we're below a year ago, and a lot of that has to do with demand, right? But notwithstanding the gyrations that are going on in the crude market, gas being a distillate, if you will, of crude, you can see that the price of gasoline is going down. And to the extent that we're able to open up the economy towards the beginning and certainly in the middle of next year, and people get back out on the road, things like that, we know that there's a positive response mechanism with lower energy prices to what happens in the consumer sector. So when basically gas is cheaper, consumers have more money in their pockets for other things, they feel better about things, so on and so forth. So to the extent that that this remains lower, it will certainly benefit the consumer sentiment and some of those other second order impacts. So I wanted to show a chart that kind of shows you the potential. And we're kind of heading to this environment at the end of the year where we've had the summer, we had a really strong market that was led by really a handful of technology stocks. Now that benefit is broadening out. There's more participation, but we're still seeing a fairly strong equity market despite having had a really, really, really bad second quarter. And as you can see here, going from 1970 to 09 to in the 1930s and even 1987 when we had Black Monday, you can see that there is always that potential when you have a really, really negative shock in your equity markets that you could actually have a good year. And so I just kind of offer that from a psychology standpoint that say, as bleak and as troubled as we felt like things were earlier this year, it's really amazing to see how we battled back. But this shows you that there's actually a precedent for that, it's not such an anomaly that you would expect it to never happen again, but we have a litany of case examples where that's precisely been the case. So, and then following on that last comment where we've had this battling back, in the market, and we've seen a strong response this summer. And it was primarily led by a handful of tech stocks. And I think we acknowledge it, we accept it. In fact, we embrace it because obviously we'd love to see a higher market than a lower market. But you can see global technology fund flows have been profound, but they've not been profound just in the span of a few months. I mean, this has been a development that's been playing out over a number of years. And even in 2018, where we saw some volatility both at the front end of the year and at the end of the year, even though that stunted the inflows somewhat, it didn't stop that trend. So this is something that I think is pretty interesting from a multi-year standpoint. So technology cumulative fund flows, I don't think are going to stop. As long as there's innovation and there's productivity to be gained and there's access to easy capital. Now I'm going to switch gears here for a couple of slides and just talk about kind of this kind of a secular trend and what's going on in dividends and income and portfolios and in investor needs and things like that. So we know that and this chart highlights that. And we saw it in 2008, 2009, when there was significant financial stress in the market, significant financial stress in the economy, that you get a lot of companies that publicly traded that either cease or suspend, in this case, or decrease their dividend rates. And we've seen a lot of that this year. That's highlighted in this chart. And what we're going to show you, I guess, is this. When you have this kind of an episode, it takes you a while to come back to the market with dividends, and that impacts certain types of investors here. But just pay attention to this one and just kind of hold this in the back of your mind over the next couple of slides that we've got a large number of suspensions and decreases this year. So this is from Goldman Sachs, and it just shows you by their best estimate that it's going to take us a while. And in fact, they don't have visibility on us reattaining those same dividend levels that we saw in 2018 and especially in 2019, which is a peak year. And so 2020, obviously there's a lot of noise. There's kind of an implied number that's kind of built into the price that I won't go into, but what they're telling you is that future implied dividends going from 2021 even out through the end of next decade are expected to be lower. And again, this is Goldman. This is one firm's opinion, and so I think it's open for speculation. But even if you assume that it's going to be lower for the next 2 to 3 years, and think about the demographic shifts and the fact that I'll just say 2 points. One, that we know that dividends have accounted for about 40% of the market return over the last, say, 25 to 30 years. And two, you've got a larger number of investors out there, older investors that are depending on the income from these investments. In this chart from the Federal Reserve, kind of reprinted in some Goldman research, you can see that that 55 to 69 age cohort has really increased their share of equity holdings. And even if you look at that, if you include that over 70 level, I mean, that accounts for a tremendous amount of the stock holding public out there. And so, these are either folks that are heading towards retirement or folks in retirement that own equities. And the number of retired baby boomers in this chart from the Pew Research Center shows you that 2020 is inspiring people to do a lot of things, right? It's inspiring some people that have worked. It's actually pushed them over the edge into retirement in some cases where people have said, I don't want to work anymore. This pandemic has really, got me upside down and I'm just ready to move out. So you've seen that spike. Well, retirees depend on income from investments in a lot of cases. And we saw from the last chart that we have a greater percentage of the older, let me rephrase that, a greater percentage of equities that are owned by an older public that need the income from that. And so with that, we've also seen a decrease in dividends, and we've also seen, the prospect of having lower overall income in the future. And so I want to bring this all together just to say that this is going to be an important variable in financial planning consultations with older clients as we head into the next couple of years. That there's going to be things that we have come to expect heretofore that I think that we're going to have those expectations tempered somewhat as we tread into the next handful of years. We've got a couple of charts here on operating earnings per share, and this is the S&P 500, and I want to focus your attention on Q3 and Q4. Q3 is a green line, Q4 is a purple line. This is just kind of a trend series, going from 2019 on the left side through basically into 2021. And so what this tells you in that green line is that we started out at like negative 25, negative 25% in expected Q3 earnings. Well, as it turns out, we were much better than that. As now all of those results have been reported. We're only down about maybe 8%, maybe even 7%, depending on how you massage the numbers. Now, that's great. We're still down year over year, but we're not nearly as bad as we were. Well, right now, the Q4 estimates are calling for negative, call it negative 12% earnings year over year. And that could, as we get closer to that reporting season, which will begin kind of at the beginning of January and into the latter part of January, that number could increase as well. We still expect it to be negative, but what this tells you is there's a precedent for expectations improving as time goes on. Earnings sentiment. This is a chart that kind of shows you in a very global way that analyst upgrades minus downgrades, so net upgrades across markets have really improved into November. So what this is doing is it's building a lot more optimism into 2021, building a lot more optimism into operating earnings, which is very positive from an investor sentiment standpoint as well as market health. I will continue to show this. Now, obviously, we've had the S&P 500 index continue to climb with a little bit of noise, but mostly in a strong uptrend. But it's broken significantly with consumer confidence, and we showed this before, I think, a couple of months ago. And consumer confidence remains kind of stuck. But the equity markets have plowed along, and you could see this really tight relationship up until the pandemic. And the question is, is there a mean reversion in the offing here? And what's going to revert? Is it sentiment's going to improve to catch up with stocks, or is the stock market going to take a pause to kind of catch up with sentiment, and that's really an unknown right now that we're going to have to just kind of watch. But I do think that there's going to be a narrowing of this gap at some point, and it's just going to be a question of where it's going to go. But I think it still kind of falls in line at some point with the notion that the equities are going to have to take a pause from this level because of some of these interim unknowns economically. And as we look at the equity markets, here's from CNN Business a chart of basically the fear greed index. And there's a lot of people that do this kind of calculation. And I won't go into the inputs to it, but there are quite a few. But on a net basis right now, if you look at this trend line over the last several years, we're at an interim peak, or we're really close to it. And while this is great from a sentiment standpoint, right now there's a lot of money flows we showed you into technology, but money flows in general over the last 3 weeks into equities have been exceptionally strong. But let's just look back in 2018. We knew January of 2018. This is right after the passage of the last tax bill. A lot of euphoria over spending. Corporations had more money. Personal income taxes were mitigated in a lot of cases, except for those that on the state level. But anyway, a lot of optimism there, and then we had a lot of we had a big sell-off in the January timeframe in 2018, and also in December. And you can see where those levels were, and they're not too far off of where we are right now. So we went from extreme greed to extreme fear. We battled back and then went back into fear in 18. 19 we kind of jockeyed around, nothing too extreme, but then we picked up in 2020. And as you remember, in January, I believe it was February 19th was the prior peak in the market before the pandemic hit. And you can see the beginning of January and heading into February, this greed factor was pretty strong, and then the bottom fell out. So I just offer this as a mechanism to say, let's not get carried away with the current environment. We know that there's a lot of enthusiasm, a lot of greed, a lot of money flow, but these things just have a tendency to kind of work themselves towards the middle, and I just want to be cautious about that. Put call ratio is basically it's a mechanism used by institutional traders to understand what the sentiment of the market is, and so it just basically means that you have less put contracts than you do call contracts. In put contracts, you buy a put if you're scared about the market going down and you want to hedge your bet. A call is going to be you think it's going up and you want to buy an option to take advantage of that. So if you have less puts relative to calls, that means you're generally much more optimistic. And you can see that we haven't been this optimistic by this ratio in a long time. And finally, I wanted to show this from Jungle Scout, and I continue to search for data that kind of gives me some insight on what the public thinks about holiday shopping this year. And this measure, about 41% say they're going to spend about the same. A quarter said that they're going to spend less, and about a quarter said they're going to spend more. So, and I've shown you about 4 different iterations of this type of analysis, and they've all come up with slightly different conclusions. And this one actually is not necessarily bad. Now we know that the Thanksgiving Day and the Black Friday spending was up. Online spending was up. Tremendously year over year. That was to be expected. But if we can maintain that, if this chart shows you, the spend mores offset the spend lesses, then I think we're going to be okay from a holiday shopping season standpoint. do it today. I hope you've enjoyed our charts of the week this week, and welcome your feedback and your comments. Feel free to reach out to us at the information that you see on your screen. Hope you have a safe week and a wonderful week, and we'll talk to you soon.